All right. Hi, everyone. And thank you for coming today to today's out of home office hours. I am Scott Pichetti, and just want to welcome everybody to this session. I'm really excited about today's session. And it seems like a lot of you all are. We had a really great number of people registering. I know there's a number of people coming in right now still. So just want to give quick introduction, and then we'll jump right into it. So as I said, I'm really excited about today's session. We have with us today, as you can see on the screen here, Chris Olsen, President of Rapport US, and Vincent Letang, EVP Managing Partner, Global Market Intelligence at MAGNA. So if any of you were able to be at the conference last May, Chris and Vincent did a version of this presentation. And when I was there, I was really excited. And I thought this would be great to share with everybody. And that was back in May, right? And this is not May, right? Things have changed. And I thought it would be great to have them come back on and just do an updated version of kind of look beyond the recovery where we were in May. 2023 looks to be very different, right, with the pending recession and things like that. So Vincent and Chris are going to come on and talk about, out-of-home forecast, market forecast, and then also talk about some out-of-home innovations that they're seeing and things that may be impacting the US market eventually. So really excited about that. And just a few quick housekeeping rules before we do kick off. Sorry, I see a question. And one question already, will the deck be shared after the presentation? So that's one of the things I want to talk about in my overall housekeeping thing. So we typically make these sessions available after the session as a recording. So you'll be able to see the images and listen to the session again. They're always available in our Geek Out library and on the Geek Out homepage, as well as our YouTube channel. And then feel free to ask questions throughout. We'll have a short Q&A as time permits at the end of the session, but I'll be here monitoring questions along with Brian Schopper, whom, if you've joined these sessions before, you know his name well. We'll both be monitoring questions and then do a short Q&A afterwards. So without further ado, again, I want to thank Chris and Vincent for joining, and I'll hand it off to them, and I'll stop sharing my screen.
All right, thank you, Scott. Okay, let me share my screen and we can get started. Scott, can you see my screen? Yes. Oops, why are we landing here? It's too early. Okay, let's go back. Sorry about that. Let's go back to the beginning. And slideshow. All right, okay. So my name is Vincent. I'm going to start this office hour with giving you some background on MAGNA and Rapport, and then I will talk about the US advertising market trends and focusing on, of course, out-of-home advertising market forecasts. And then Chris will follow with some thoughts on out-of-home innovation. Okay, so let's start with some background, who we are, MAGNA and Rapport. Well, we are sister agencies under the IPG Media Brands umbrella, and therefore also sister agencies with Initiative and the many clients Media Brands represents. Some of the big ones include Amazon, BMW, J&J, and so on. About MAGNA specifically, well, MAGNA is about investment and market research, and I'm leading the market research side of MAGNA, where we create and publish about 50 reports per year on ad market trends, media consumption, media industry trends, and we've been doing that for 70 years, believe it or not. Recently, in September 22, we published a global report on out-of-home market trends. Of course, you probably know Rapport, which is the expert agency on out-of-home in IPG Media Brands, with an international presence and 150 plus clients. All right, let's get started with the out-of-home market trends. We're going to do that as in a funnel way, meaning starting with an update on the economic outlook, the economic environment we expect in the US in 23, and then how much advertising spending we expect, and then what it means in terms of out-of-home advertising sales for 23. So the economic environment first. Here you can see the last 3 updates on expectations for 23 from the Survey of Professional Forecasters, which is a quarterly survey of US economists. And so the latest one was November. There will be a new one in February, but November is the latest one. And you can see, if we look at the left, real GDP predictions for 23, it started in May 22 at 2.3%, and then it was reduced to 1.3 and then 0.7. So we're looking at 1% or slightly less GDP growth in 23. That means economists do not predict a severe recession as 2009 or 2020, but a sluggish stagnation essentially for 23. If we move to the next economic indicator, here the expectation hasn't changed much in recent months. They expect about 3.4% inflation next year, which is a good news, which is really cooling down from what we had this year, and I'll come back to that. And maybe I'll skip to personal consumption, which is an important indicator because it's a proxy for retail sales and marketing investment. The expectation has been reduced to 4%, which is not super strong. And finally, the good news is unemployment, and that's really what's different with the previous recession. I mean, if we are having a recession in 23, it's going to be a mild one. The same economists that are predicting economic activity to slow down to 1% growth predict that it's not going to boost unemployment higher than 4 or 5%. So that's the really good news, because in 2009 we were close to 10% unemployment, and that really has a deep impact on consumption and retail sales and marketing expenditure. A few more economic insights. Consumer confidence, of course, is important. We in June of 22 we reached an all-time low in terms of consumer confidence, lower than any point during the COVID crisis. And it had a lot to do with inflation and the cost of gas in particular, and of course the concern about a recession and about the war in Ukraine. Since then, it has recovered a little bit. In January, we stand at 64. This is still low, right? This is still lower than at the beginning of the COVID crisis. And to give you perspective, during the Great Recession 12 years ago, it was around 55. So we are barely above the level of confidence we had back then, but it's stabilizing. Retail sales, as you can see, they were strong actually through that 22. But if we look at but it was slowing down, and towards October, November, it was down to 6%. Considering at that point there was about 6 or 7% inflation, it means retail sales were no longer growing in real terms. They were just growing in nominal terms. So I guess these numbers are not so good as they look. Back to inflation, the good news is it's peaked in around June, at the same time as gas prices reached $5. And by the way, now gas prices are below what they were at the beginning of the Ukraine crisis. And in December, the general consumer price index was increasing by just 6% year over year. So we are indeed on the right path to to realize the economists' prediction of inflation rates going under 4% in 23. And by the way, there's no mystery about it. By raising interest rates, you are almost mechanically curbing inflation. But of course, it comes at a cost, which is to reduce economic activity. So it's necessary, but it's a dangerous game indeed. But for sure, inflation will soon be under 4%. Consumer mobility is mostly back, but there are big differences depending on where one looks. And I think I picked the two extremes here. On the left, you have US domestic air transportation has already recovered to the pre-COVID levels, 67 million passengers per month pre-COVID. And we reached 66 million in October of 22. So that has really recovered, in possibly faster than some people would predict. And of course, it means the airport traffic has also recovered. At the other end, we see urban transportation struggling. Here we take the New York MTA average daily ridership. It fell to 400,000 during COVID lockdowns. And since it has grown, but it seems to be stagnating now at around 2.83 million per day, which is 35% below the pre-COVID level. So it's not clear if we'll ever go back to pre-COVID levels of traffic in terms of large cities, public transportation. While, of course, commuting has not recovered fully, and but driving has, and driving has clearly taken market share away from public transports, which means basically the out-of-home audiences have shifted in the process. So here, what does this economic environment means? Here we try to map the key industry verticals based on their sensitivity or vulnerability to economic downturns, and also to inflation, because the sensitivity to economic downturns is very well known in microeconomic terms. Typically, CPG products, food, drinks are the least vulnerable. Essential services, the same. Insurance, broadband subscriptions, education is not something consumers will easily cut in an economic downturn. But at the other end, durable goods, big ticket items like automotive, furniture, home are more at risk of being cut or delayed. If we add vertically the inflation dimension, it's a more complex picture with CPG becoming at risk. And we've seen in 22 that CPI inflation was even stronger than average when it comes to food and drinks, 10% or more for some products. Everybody talks about eggs, and it's bad news for premium brands that see the risk of consumers either reducing their consumption or trading down to cheaper brands, retailer brands, and so on. So CPG in that environment is more at risk than it would be if it was just the economy slowing down in this inflationary environment. But the peak of inflation, as we said, is probably behind us, and things are getting better. In case you're wondering, here I've put in pink the industries that are over-indexing when it comes to out-of-home use. So in terms of vertical spending, and this is, by the way, this page is not just out of home, it's for all linear media spending. Essentially, we expect CPG to continue to underperform in terms of marketing and advertising spending. We expect entertainment, travel to outperform again, and we expect automotive to come back. And I maybe have some more insights for you about automotive. Entertainment and travel are relatively strong verticals for out of home, so it's good news. And CPG sectors are quite small in for out of home revenues. So the fact that they are struggling is not necessarily too bad for the out of home sector. One thing we do also beyond those big industry verticals, we try to look at smaller verticals that are growing fast from a low base, and these 5 or 6 really exploded during COVID, all of them. And here we see their performance in 22, which was not so great. Typically, if we start from the left, home exercise equipment, brands like Peloton and many others, it really did the good business during COVID, but it's now going away, and the reduction in marketing investment is reflecting that it was a bit of a fad. Marijuana keeps growing, but sports betting, fintech is slowing down. I mean, in the long term, sports betting and fintech are growth sectors, but it slowed down in 22. As for crypto, which is part of fintech, I think this 600% is really an average of 22, but it slowed down a lot in the second half due to the issues on cryptocurrencies themselves. So here the takeaway is that 2 years ago we had a few small but fast-growing verticals, new products. Some of them will continue to grow, but we won't see the 3-digit growth rates we saw in the past on those. All right, the car market is really interesting. We've seen car sales growing again since August, and we think we believe it will continue in 23. So we think the car market has finally turned the corner, and 3 factors will fuel automotive ad spend growth in 23. First, easy comps, for sure, and it will almost guarantee some level of growth in the first half, okay, compared to the very small sales and advertising investment in the first half of 22. Then supply and inventory will recover. There are some early signs. I mean, semiconductors are not fully back yet to the pre-COVID production, but cars in dealership lots are growing a little bit. The time between the time a car stays on the lot has increased a little bit from all-time lows, and even more interestingly, we saw in 22 that auto spending, at least manufacturer spending, didn't fall that much. It fell by maybe 10%, 15%. Okay, that's 10, 15%, but considering that they didn't really need to advertise to sell the few vehicles that were available, I think it's good news. I think it means that most of the budgets were reallocated towards long-term marketing goals. I think it's a sign of marketing maturity that they decided to concentrate on long-term branding goals, educating consumers on the long-term transition to electric vehicles, building their brand credentials on electric vehicles, and so on. So I think this will continue in the next few years, and it will fuel the recovery of automotive advertising and marketing. Right. So with this is our prediction for 23. Overall, net ad spend will grow by 3.7%. That's across all media. and it breaks down with a -4 in video. And by the way, that this is cross-platform video. It includes national TV, local TV, and digital video. Audio, radio and digital audio, flat. Publishing, -1.8. Out of home, let's say +7. Search +11, social +5. So following a +1 in 22, social media advertising really came to a halt in 22 compared to the growth rates we had in the last 10 years. We think it will stabilize and maybe grow a little bit again in 23, but we won't go back to the kind of growth we had for social media just 2 or 3 years ago. All right. So now we look at out of home specifically. 22 was a very strong year. We have the result of the first 3 quarters. These are the year-over-year quarterly growth rates for media owners' revenues, and the rest is our forecast. So we think Q4 will be good, and then it will slow down like everything else in 23, but still reaching 6.8% growth on a full year basis next year. Now, if we look at the long term, this is our scenario for the next 4 years, showing further slowdown. It's also based on the assumption that inflation in the economy will slow down. Essentially, we anticipate that digital out-of-home sales will grow by 10 to 13% per year, while static or classic units will show stability, little or no growth. Putting all that together, it gives us 4 or 5% growth per year, which is much better than any other traditional media type, TV, print, and audio, where we expect something around -2, -3 for the average annual growth rate. Also, if we compare the performance of out-of-home to other linear media types before and after COVID, you see if the year 2019 is index 100, well, total linear media, which would be TV, audio, out-of-home, radio, fell to index 79. Out-of-home, of course, suffered even more, index 74 in the year 2020. But then linear media recovered, out-of-home took more time to recover. But as of last year, out-of-home advertising revenues have entirely recovered to the pre-COVID level. And by the way, only a few other markets outside the US have achieved that feat that quickly. One is Germany, but for instance, France, the UK, most other markets, they will need at least 1 or 2 more years to fully complete the post-COVID recovery. So it's pretty remarkable how well the US market recovered. And as I said, we expect more growth in 23, while the rest of linear media will stagnate. No surprise, the outdoor segment in the out-of-home business have recovered stronger and faster than the indoor ones. As you can see here, when it comes to transit and place-based, we think it will need 1 more year to fully recover, but the direction is the same. It simply took more time to rebuild audience and ad sales. And this is the performance by environment: billboards, transit, street furniture, retail, and total. So if we take 23, that would be the gray bars around an average growth of 7%. We think transit and street furniture will perform, and retail will outperform between 11 and 16% for those three segments, while billboards, which of course was more resilient to the COVID crisis and recovered also faster, billboards will slow down, or at least not grow as fast as the other three segments. Of course, billboards being by far the largest segment, it's also a long-term trend to see transit, street furniture, and retail gradually increasing their share in the out-of-home market. An indicator we monitor, of course, is the proportion of digital in total out-of-home ad sales. It has reached 29%, let's say 30% last year in the US, which means that the US is pretty much average if we look internationally. But it's still a long way from what we see in the most advanced markets like the UK and Australia, which are around 55-60% digital now. We may never reach those highs because of the structure of the US market, but still we think it's going to grow to 40% in the next 5 years. Clearly, digitization is going on, and it didn't stop during COVID. Investment continued, so we think there's a path to reach 40% within the next 4 or 5 years. Finally, programmatic, the takeoff. Really, the last 2 years, we've been talking about programmatic for many years, but it really took off during the last 2 years because digital penetration and reach achieved critical mass, because all parts of the ecosystem was finally on board to explore the programmatic opportunities. Media owners, brands, agencies, local advertisers. One big factor was that omni-channel DSPs started to connect with digital out-of-home networks, adding a lot of reach and scale to the previous situation when it was mostly specialized DSPs. So now we really have scale, and essentially that means that industries and brands with little out-of-home usage traditionally, but big programmatic usage, some of their these programmatic budgets will find their way into digital out-of-home almost mechanically. So it will really contribute to create an organic growth factor here for out-of-home. So these are our estimates and predictions. We think we've reached about $200 million in 22, which is about 9% of digital out-of-home sales. So it's still relatively small, but it grew by 56% in 22. We anticipate 42% growth in 23. So it's small but growing quickly, and most importantly, it's not cannibalizing any other out-of-home investment. It's really brand new money flooding into the out-of-home ecosystem. So key takeaways on market forecasts. Out-of-home not only survived the COVID crisis, but recovered strongly, faster than expected, and looks more attractive than ever now. Ad spend is bound to slow down in 23 along with the economy, but MAGNA expects out-of-home to outperform every other traditional media type again, like it did, by the way, pre-COVID. And finally, digital and programmatic opportunities remain long-term drivers that will ensure this outperformance of out-of-home will continue in the next 5 years. All right, with this, I'd like to ask Chris Olsen to tell about us, to tell us about the innovations we are seeing in the sector.
Awesome. Thank you, Vincent. First of all, thank everyone for joining. Vincent, love hearing your take on 23 and beyond. I'm going to touch just on a few trends, maybe some innovations that really have worked well for us at Rapport over the past couple of years. Most of these you will be familiar with and probably very familiar in me doing things. A lot of times what we like to talk about is just like the influx of it's actually becoming real and like the percent growth and some things like that. I like to start with a quote here, just kind of encapsulates this as an iteration of this quote. But out of home in general, it's like when you try to be everything to everyone, you accomplish being nothing to everyone. And like I definitely believe those words. I tend to agree with that in most cases. Out of home, though, I think kind of sits outside of that. I do feel now that we've got this war chest of metrics, tactics, measurements, social endeavors. And we've seen a lot of that evolve over the past few years. And of course, so much more to work on to continue to grow. But I do think out of home delivers this really inherent and really impactful and surprising, the most creative impressions in the totality of the media world. And typically always, rooted in this contextual relevance. So we've got a good playbook. If you want ad recall or ROI, like out of home does that. If you want performance, I do feel that we've expanded to lower funnel. We are a full funnel channel at this point. If you want targeted data that, by unit even, that changes the game for efficiency and advanced targets, and that's standard now. Social relevance, I think we've evolved there as well. So, as part of the agency world, and I'm sure very similar to those on this call, we have aggressive growth goals every year. If Vincent forecasts 7% out of home growth, no chance we're getting that. We need to double that typically. We got to be in that 12 to 15% growth for, agencies to do well. And I'm sure, others on this call as well. So as we look at the beyond recovery, we're just going to dive into a few of the trends that, we've seen either emerge, as I mentioned before, just poised to make a bigger leap. Some are media-based, some are tech-based, some are even just like data strategy. We can start with AR. So, obviously huge uptick here in just the ask to incorporate AR into our experiential executions. I think this is an area where there's considerable upside across the board for media owners, agencies, clients alike. I think from the creative side, it provides this, immersive experience. One of the things that we did last year was Ed Sheeran executed, or he launched his album in the UK, and we had this huge AR experiential build out with Atmos 3D. We had sound in it, we had projections, we had like floating butterflies, and I think what we love about that from a media side of it is that it's completely trackable as well. So it's got this really great creative portion to it, but we're tracking the views, we're tracking the time spent engaged, we're tracking drive to streaming measurement, which obviously for a client like Spotify is incredibly important. I think it's been a little slow for the adoption. Actually, when we first did this presentation in May, I think it was going to be a little bit higher, but Tech Jury has projected that the AR market stands around 5 billion now, and it's going to be worth 18 billion at the end of 23. So it's a huge uptick there. I'll just go through a few other stats that I find interesting about it, because we do feel like this is a giant pool to play in. But it's looking at like 1.7 billion augmented reality users by the end of 24. Obviously, the connection between mobile and out of home and the synergies there. 70% of the consumers believe that AR can bring them benefits. So then you've got this consumer output and this need as well. So you've got the creative, you've got the media, you've got the consumer. The revenue for AR is projected to hit 340 billion by 28. That's huge, obviously. And then you've got the supported media planners and buyers in the agencies. So 67% of that group wants AR and VR ads in their digital marketing campaigns. So that's really the size of the marketplace, and we'll see, how that bleeds into it in the next couple of examples as well. Anamorphic, I think everyone knows that. This is digital out of home's kind of having its moment as this is a new tech and evolving, and really took off last year. It blurs the line of content and experiential, and I think while 3D illusions were no stranger to the event scene, I think Anamorphic's really hitting its stride here. Vincent, if you want to play that Amazon video really quick. All right, well, there seems to be no audio on this, but and everyone's seen Anamorphic, so you can just watch it in the background. But I think it's, as everyone knows, it's an optical illusion. It's 3D art. You have to be at a very specific vantage point to get the full effect of it. But the goal really is that additional value for mass social sharing, and really get the buzz out there for those who were to experience it in real life. So we've seen, interestingly, about 600% increase in bookings of anamorphic year over year. And we just looked at 22 versus 23, and the RFPs that are coming in for anamorphic are like incalculable. It's like plus 15,000%. So we do feel like this is a trend that is here. I feel like a lot of people have done it, but it seems to be increasing quite a bit. And then if we go to the next slide, it's really like this is 3D, and then we move into 4D. So this was an interesting one. I'm sure you're aware of this one as well, but MSG is building out the world's largest spherical structure. It's 360 feet tall. It's very wide. It's got 600,000 square feet of LED exterior. It's one of the largest arenas in the US with 20,000 people capacity. Interestingly, it's got like 10,000 seats that are equipped with this haptic system, which is an immersive 4D. Your seats rumbling, there's like things being blown at you, there's like water shooting at you, things like that. Obviously, it's got a huge audio system there. It's got some built-in events already, CES, Formula One. It's got award shows. There'll be musical residences there as well. The advertising opportunity is interesting, and this is where it could become a trend. And it exists in other areas and other pockets too, but there's trailers and there's pre-roll spots prior to any of these immersive shows. But the spots are going to need to have that look and feel and interaction of the content that they're housing there. So I think there's something to be said for that. If you look at just spots in movie theaters, like from many years ago, they come to life just in a different way on big screen than other channels. If you look something more recent, obviously, you look at TikTok, Instagram, their click-through rates and their cost per acquisition is incredibly impressive. I was talking with our Amazon planning lead the other day, and their large portion of their digital budget is now moving into TikTok just because of their algorithm obviously really works well, but it's also, they have really bespoke endemic creative there that feels natural to their content. So I think everyone strives to have that. I think in these more immersive worlds, that's incredibly important. So I think one of the tricky trends, though, immersive seems to be the way that we're headed in certain areas, especially with, as we talked about, like the endemic nature of how spots can be run, consistent with the content that's actually being housed there. But is there scalability to it? This sphere was like $2 billion. So you may get a handful globally, but what's the trickle down to more accessible infrastructure? And that's something that probably will not shake out for a few years. But I on a personal note, I went to the American Dream, the mall in New Jersey, like 1 month ago, and they had a 70 experience. And I think that is exactly what the sphere is like, but it was pretty cool. You're shooting zombies and you're shooting robots and stuff like that. But the tech is there. It's just the translation to the brand use and how it makes sense. And we can go to the next slide. Okay. Yeah, so out of home, I think often introduced as like the oldest media format. I think that comes off sometimes as dated or just unwilling to change. But I do think the industry has reinvented itself specifically since 2020 and on really a lot of progressive and socially driven initiatives. If we look at just various lenses of data privacy and DEI and sustainability, a lot of that's been brought forward and evaluated. I think it's been pretty invigorating to see the way at least Media Brands works with it. To know clients' plans can be scorecarded against these metrics, and plan deliveries are not just like, okay, I want 95% reach on my target, but how is the carbon consumption with that? How many Black-owned companies are on this? It's really this intersection of those pillars that I think showcases the evolution of our medium. And clearly there's a lot of momentum here. Media Brands rolled out its MRI, which is the Media Responsibility Index, that evaluates plans over a handful of metrics, as I mentioned, DEI, privacy, and of course, sustainability. Of course, with sustainability, we have our own carbon calculator. I know WP does, Dentsu as well, many others. But what we like about this is, we really can provide that carbon-based information back to the clients if that's a major initiative for them, and they can plan off of that. So we go to the next slide. There is consumer sentiment here as well. The UM did a study recently, and 60% of the people want to know that the brands they support are doing, something to address the social and environmental issues. 91% of millennials would actually switch brands if one is associated with a cause. 74% value data privacy as highly as any other societal issue. So all these things are being addressed, and that comes out in the way people are doing plans now, especially certain advertisers. And then if we just look at the next slide, Vincent, advertisers that are based in sustainability and equity and integrity are seeing more consideration and lifetime value, and all that's growing. At the last 4A sustainability conference, this was kind of compared to digital transformation. If you didn't do it, you'd be left behind. And hopefully that's what we're going to see here, to be honest. It's more of like a rising tide, not to be necessarily monetized for revenue, but just coming together as an industry for a common goal. And I think there's great movement in the space so far. Like the code moving to mostly renewable energy. Some are using only recyclable materials. One thing that we're proud of at Rapport is our use of titanium dioxide. And Vincent, I think you can go to the next slide on this. And that is, for those not familiar, it's an air purifier that pulls pollutants out of the air, and NOx, which is, I think, 30 times worse than carbon. So really, we're just spraying any and all vinyls at locations we can. It's our second year of doing this. The give back has been fairly significant. We took off 25 million miles of driving, and also it's equivalent to planting 200,000 trees. So I think we're proud, yes, but there's clearly so much more to do here. And how do we evolve it? What's 2.0? What's 3.0? We've had some great recent partnerships with Vector and Colossal and Outfront to Co, just to name a few, to spray surfaces like bus shelters, buses themselves, painted walls. So ideally, hopefully in a couple of years, any media that we're putting out in the physical world is going to be utilizing this strategy. Yes, then moving on. So also, yes, here we have really, as an agency or any media owner or clients, constantly looking at untapped areas within the industry, really to see new incremental budgets. So we've really come into it with pharma. I think it's one of the segments that has tremendous upside. It all starts with the data, and with recent Crossix and IQVIA integrations into some DSPs, and some of the major vendor partners have made it relevant player again. Clear Channel's done a really good job of kicking this off and really elevating just that traditional out-of-home media to be aligned with pharma's endemic research, which was always the barrier previously for investment. So, we've seen traditionally pharma's foothold really in out-of-home is just doctor office and POC channels, and they do quite a bit of that. And that's surely going to continue, but I think the expansion to more mass and accessible formats has begun. Indexing by format and subsequently tracking script lift is a potential huge upswing for both industries. We actually did something with Stellar recently, and it's not even recent anymore. I mean, it was a 6-month campaign, and like the tricky thing is the long tail of research is like 6 to 8 months. So we did get that back recently, and it was 76% script lift in using non-POC out of home, and it was 75% lift in getting patients into the category. So really a good case study. It's a strategy we're for sure going to employ across our pharma brands. Vincent, I think we can roll to the next one. Yeah, and then this is just a trend that we've seen much more over the past year. It deals more with sports betting, live result genres. So it's really planning for agility more than anything. But we've seen a lot of momentum in socially sourced content that provides the creative narrative, but backed also by like optimized RFs per market. Some of this was presented by the Ad Club. It recently won the OOHOH Plan of the Year. But essentially, NBA executed a 16-market campaign for the playoff teams, featuring live scoring updates, hometown team wins, countdown to tip-offs, and it was all, well, most of it socially sourced. There was real-time updates, and it was all optimized by reach. And just touching on some of the key pieces here, the objectives. Typical for something in entertainment like this, it was tune in. Target audience was interesting one and tricky, as it is sports fan, but it was also casual sports fans. So you had to kind of figure out when you're going to be reaching either of those based on how their team was doing in the playoffs. The role of out of home in this one really create hype. Again, get that tune in intent, but creatively they wanted to have a lot of cultural significance. Really, it was more like brand love as well. And the challenges for me always are more interesting. So if we move to the bottom, live sporting events, it was 16 markets. They were pretty much TBD because you didn't know who was getting in, well, at least the bottom seeds. And you didn't know what the flights were over this 10 period of time because teams were eliminated, maybe they shouldn't have been. And so you can't really plan out NBA playoff bracket. The creative ask, again, was really brand love, relevance to compel players, fans, celebrities to engage, and then we were going to post all that. And then the ability to deliver dynamic creative. So it was mass scale, it had to be fully automated, something that typically had not been done before. And then, the way we achieved that is obviously the mechanism was programmatic. That was the only way we really could do this. So we would flip on these digital screens as they were doing well, and we would deactivate them immediately after the team's elimination. And we'd also serve up ads based on where each team is located, but also the audience within that, sports fans and casual fans. So as the NBA has a lot of insight into this, of course. So when the playoffs start, you're getting your more hardcore fans watching all these games, but as the playoffs progress, you're going to get more casual fans just as you get closer to the finals. So there were a lot of interesting audience evolutions within there that you had to also manage programmatically and with dynamic content as well. So as we mentioned before, it was the first kind of major integration across a huge digital out-of-home ecosystem. We ignited the brand love and the relevance through game time countdowns, live scoring, hometown wins, and it was all moderated 24/7, which obviously you would imagine with Twitter at the time. So it was also a nice way to tie into what was being done from the channel planning side as well. So when they had digital takeovers on Twitter, and we worked with Vistar and Dive on this one, but also had to tie into the digital team. So we would do Times Square takeovers and they would do Twitter takeovers on major days. And then if we get into the metrics of it all went really well. It was the highest rated NBA Finals in 3 years, which, with declining TV ratings, I think that's impressive. It was a 25% lift in tune-in intent, 25% lift in playoff consideration. There was a nice 7% lift in playoff awareness. And then we had a lot of social chatter, of course, on this as well, with over 1 million Twitter mentions. So I liked it. It was an advanced planning type of scenario and something that, I can see probably being an annual campaign, but the extensions into other entertainment, other tune-in is there as well. And we just really liked the way that it played out with content and really like it achieved on its goals. So we were happy with it. But actually we do have a video. You may have seen it before. It's got Eminem in the background. So if you've seen it, just listen to him. Or maybe we don't. Okay.
All right.
Let's go with it.
It is a great video if you haven't had a chance to see it. I could do the voice, I can sing it if you want. So
Not do that.
You don't want that, right? So, but thank you so much, Chris and Vincent, for this. It was really compelling information, really exciting information. I'll turn my video on. I was always very excited about having this session. If anybody has questions, feel free. We are getting tight on time, so might be able to have 1 or 2 questions, but just stepping back and looking at everything. I mean, my takeaway is, and I think it's even been said in the session already, things look bright, right? The future looks bright, but we can't rest on our laurels, so to speak, right? Like you said, Chris, you're going to need to keep pushing, all these, we're set up to do well. Any like broad recommendations, Chris or Vincent, for everybody listening that you would say, like, what do they need to do, or what do we need to do as an industry or as a media owner, as an agency to really begin to capitalize on some of the opportunity out there? Is there any bits of advice or anything you'd say broadly or even specifically? I know it's kind of a hard question. I don't mean to put you on the spot, but anybody?
Yeah, I can take that.
Yeah.
I mean, to me, relevance is everything. I think, you know, there has to be, when it becomes cookie cutter, it's just wallpaper. So, you know, I think what teams appreciate when they're getting plans in is a truly strategic like partnership, and not necessarily something cookie cutter. And then that will get things across the line, help sell through. I mean, we see when things are done well like that, such a higher take rate from the client, and then repeated, like brought up lifetime value a lot, but this is like repeat lifetime value from a media perspective, and they tend to sign on to those certain campaigns again, like MDA. Like we do feel that will be coming back next year, and you know, there's certain ones like that across all of our clients.
And I know we were talking earlier, but like so applicable to the NCAA tournament, to, you know, the World Cup, like all of these multi-week sporting events that are happening. You know, it's really interesting. I thought that was a really interesting case study. You know, one thing, Vincent, I did see coming on the call, maybe we should have had this session tomorrow instead of today. I saw the new forecast. The GDP actually was much better than they predicted. So any thoughts on that and how that's going to potentially impact anything?
Yeah, I mean, I think we need to be cautious, right? It's going to be a year of slow economic growth, you know, and maybe it's going to be slightly better than 1%. It could be worse than 1%. So essentially, it's a stagnating economy. So we expect advertising spending to slow down for most categories. That being said, we're confident out of home will outperform. Okay. Because of innovation, because of some industries coming from a low engagement with out of home and increasing that through digital or programmatic. And to your earlier question, what the industry should be doing, I think they're doing really a lot of good things. And I think the investment in digital and programmatic technology is paying off. And we can see that internationally when we look at other markets, pretty much wherever there's been investment by large and small media owners, both at both ends, large scale media owners and niche specialists, but in both cases, investment in technology, it's paid off, and we see those markets grow faster than others. And the US is, as I said, doing pretty well because it recovered from COVID faster than most, and the digital share reaches 30%, which considering the geography of the US centered around small towns is a lot. You know, I don't think we'll ever reach 60% like the UK, but 30% is already remarkable, and it will continue to grow. So yeah, I'm pretty optimistic, about at least the ability of out of home to outperform the rest of media in this difficult environment. But we should expect growth rates to, of course, slow down from the very high growth rates we've seen in 21 and 22, obviously.
Sure. Great. Well, I mean, it's all good news. One last question that did come up, and Chris, I'm not sure if you would even know the answer to this, but around the air purifying boards you have, do you have any sense of how long that takes to see an impact? I mean, it sounds like you're already seeing some level of impact, but do you have any sense of that?
Yeah, there's a very unique science to a very I'll have Molly speak to this one because that's her jam, but it's very much like per square foot gives this much back. So it's very measured out. I see Elena's, her question. As soon as the substance goes on the vinyl though, and interacts with sunlight, it is working.
Cool.
So
very cool.
Basically immediately.
Cool. Well, just again, want to say thank you so much. I really appreciate you both working with me and getting this session on. I know people enjoyed it. I could see by the turnout. So thank you so much. I just want to do one quick plug, if I may, for our next session. If everybody wants to just let me share my screen quick. Okay, so next session, just mark your calendars, February 14th. We're going to have a fireside chat with Dylan, our president, and Jim Wilson, CEO from Talent America, on why out of home should be your choice of media for 2023. So you'll start to see some communication registration links coming out for that shortly, probably next week. We just wanted to get that on everybody's radar. So again, I want to say thank you for attending. Really appreciate it. I want to thank Chris and Vincent one more time, and just thank you all, and thank you everyone. So have a great rest of your day.
Thank you,
you,
guys.
Scott.
Thank you.